talking you through the ISSB guidance and requirements on how to quantify potential financial impacts of your climate-related risks and opportunities. Before we get stuck in, just a couple of quick admin points. Everyone's joined on mute as standard. We're going to be running a very quick, simple poll shortly to get a sense of where everyone's up to in this quantification process. And we've allocated plenty of time for questions and answers at the end of the session, and we'll be monitoring the chat as well. So please do put through any questions that you have. A quick recap of the agenda itself. We'll do a couple of quick intros, then we'll give an overview of the ISSB S2 requirements around financial quantification. Then I'll pass over to my colleague Rob Charnock, who will take us through how to do it in practice. And finally, a couple of us will go over a few examples of real life disclosures from financial statements. Facilitators today, Jake Atkinson is Principal Consultant of Climate and Nature at RSK Australia company Edge Impact. He's actually not on the call today owing to time zones, but he's done a great deal of work in pulling this presentation together. Rob, do you want to say a few words?
Yeah, sure. I'm Rob, dialing in from Singapore. So my background is really climate finance and carbon accounting. So my PhD is in the topic, and then about 4 years ago moved to Singapore to establish the Metis Institute. It's backed by RSK and focuses on research on the latest methods around sustainability reporting, as well as training on the topic too. So for example, things like financial impact assessment, we're getting a lot of requests to support teams on that at the moment, and we'll be going through the methods today. Thanks, Andy.
Libby.
Good morning. I'm Libby Robinson. I'm a principal consultant in the carbon, climate and sustainability team in the RSK company Nature Positive, alongside Andy here. So I've got a PhD in climate science, and that's my background, very much scientific basis. And I head up the environmental impact and climate risk work within the company, within Nature Positive. And that works on a wide range of industries for both companies and projects on the ground as well. So we're quite experienced in doing a lot of climate change risk assessments and looking at the impacts on companies of these. So thanks. I'll pass back to you, Andy.
Thanks, Libby. I'm Andy Greenall. I'm the director of the Carbon, Climate and Built Environment Sustainability team at Nature Positive. Okay. Just before we get to the agenda, just a quick word on the RSK Group and the different RSK businesses that work in this area. So this presentation was largely put together by Dr. Rob Charnock of our sister organisation, the Metis Institute in Singapore, together with Jake Atkinson of RSK Australia company Edge Impact, who's, as I mentioned, not on this call owing to time differences. Edge Impact are primarily based in Australasia and South America and tend to focus on the APAC and Latin American regions, while the Metis Institute's in Singapore and works across Southeast Asia. Libby and I are part of Nature Positive. We're UK based but work internationally, and there's various other RSK companies as well working in the climate risk sector, including Amphos 21 in Spain and South America, ADAS in the UK who focus on the land sector and flag, WRC in the UK who work in the water and infra sectors, International Projects Group who work internationally, losing the name, and then there's Pegasus who are based in the UK and South Africa. So RSK's got a great deal of both expertise and regional knowledge and coverage when it comes to climate risk. Just going to throw over to Libby for the next couple of slides.
Thank you. So firstly, some context behind what we'll be looking at today, and apologies in advance for the acronym SOUP. You can't really escape it in sustainability, but hopefully a lot of people will have heard of the International Sustainability Standards Boards, the IFRS framework. So the ISSB, it's an independent standard setting body which came out of COP26 at Glasgow back in 2021. It developed the global baseline of sustainability disclosure standards for companies in its two standards, IFRS S1 and IFRS S2. So the climate-related disclosure standard, IFRS S2, focuses on climate-related risks and opportunities and their financial impact on a company. And this builds upon the framework of the work of the TCFD, so the Task Force on Climate-Related Financial Disclosures. So since the announcement of S2, 16 jurisdictions have adopted in full or an equivalent standard, with a further 20 set to adopt on a voluntary or mandatory basis. In some cases, these might be equivalents, such as the EU's Corporate Sustainability Reporting Directive, CSRD, or such partial adaptations such as the United States, where it's not happening at the federal level, but we're seeing some state level disclosure requirements there. The Australian region in particular, it's storming ahead with the integration of ISSB, with those first wave of disclosures expected in 6 weeks. But who's this webinar for? Really, it's for any practitioner interested in applying the standard, for anyone wanting to understand what's required from quantifying these climate risks, and anyone who wants to see practical examples of how we typically see it being performed. On which, just as a little interesting side note, we're just going to run a quick poll to gauge the general level of experience on the call here. So I'll give you 30 seconds or so to put in your answer here in terms of where you are in your climate quantification journey. So whether you've not started, whether you're just getting started and just starting to think about it, whether you've identified the risks and you're looking to quantify, you've started that quantification process, or it's all done and you just want to make sure you're on the right track and see what other companies are doing out there. So I'll give you a little bit of time. It's all anonymous, so please feel free to be completely honest. I'll give you a couple more seconds and then we have a look at the results. What have we got? We've got, that's interesting. So that's quite similar to what we see at the moment. A lot of people are just getting started or they're relatively early on in the journey. Some more mature companies have started this quantification process, but because it's such an iterative process and a process where you learn by doing, and it's in its very early stages in terms of industry standards, a lot of people are quite early on in this process. So that's really good to see. It's nice to see that some people are a little bit further on in their journey as well. Great, so on to the next slide. The central objectives of frameworks such as the TCFD and the ISSB is to encourage businesses to evaluate and disclose the material climate-related risks and opportunities that are most pertinent to their business activities. So these are risks and opportunities that affect cash flows, finance, and the capital of an organisation. And how do we do this? Well, a company first identifies any risks and opportunities related to both the transition of the world to a low-carbon, climate-resilient economy. They're called transition risks and opportunities, and also those risks and opportunities associated with the physical impacts of climate change, such as increasing temperatures or changing patterns of rainfall. A climate change risk assessment process is undertaken. This looks at different time horizons and future scenarios, and this is integrated within an organisation's wider risk management processes. The financial impact of any identified material risks and operations can then be quantified and published within the annual disclosures. And this quantification process is what we'll be discussing in future slides. There's increasing pressure on directors to provide more insight on the financial impact of climate-related risks and opportunities and how they've considered them. And so really from company to company, the relevance and the materiality of these climate-related risks and opportunities will vary. So this therefore requires management to make judgments about the nature of their disclosures as well. So just as an example, this slide, it shows some examples of financial impacts. It's taken from the CDP Climate Change Questionnaire back in 2022. And the green colour here represents those relating to the transition to the net zero economy. Grey is those related to the physical impacts of climate change, and blue is both. So on this slide, it's interesting to see that for the most part, businesses identify transition risks as those most material to the company, particularly regarding increased operating and direct costs, decreased revenue from reduced demand. The physical impacts really lie predominantly in the decreased revenues from production capacity. On the flip side, where you've got risks, you often have a mirroring opportunity. There's corresponding opportunities in the transition risks and opportunities section, with increased demand fueling increased revenues, reduced operating and direct costs, and these are primarily through resource efficiency and renewable energy, and also increased revenues from new markets as well. And so now I'll just pass over to my colleague Andy, who will go through a little bit more detail.
Thanks, Libby. Before going into further details, it would be useful to collate some key guidance docs. There's a lot of really useful, valuable guidance out there, but it's not terribly well integrated, and it's certainly not in one place at the moment. So the ISSB S2s are the IFRS climate-related disclosure document itself. ISSA 5000 contains some really useful guidance on materiality that we'll be touching on later in the presentation. And the IAS 36 is an accounting standard about asset impairment and writing down asset values effectively. The WBCSD climate-related financial impact guide is a really useful general guidance, well worth a look. I recommend having a look at that if you've not got to it already. And likewise, the IEMA, now called ISEP, guidance on the user guide to climate-related financial disclosures is really clear and very useful. That's guidance on how to read CFRD statements rather than how to write them. But obviously, there's a lot of overlap there. What are you actually required to disclose under S2? It's useful to think in terms of three distinct buckets of what needs to be disclosed. The first one is current impacts, current expenditure. This slide shows, these are just the abridged versions, but this slide shows the S2 requirements around current impacts, or what has happened to the entity in the current reporting period. That's as opposed to projections for future forecasts. For example, you need to disclose the effects of your material, highly rated climate risks on your financial performance and cash flows, how those risks might result in material adjustments in future. You might need a provision for expected future expenditure, or perhaps you need to impair some assets due to a reduction in revenue or shorten life cycle. In addition to financial modelling, there are some specific metrics required around investment in mitigation adaptation, capital deployment, and certain disclosures around remuneration and KPIs as well. The next point is around the anticipated effects, which I think is probably what most people initially think about when they consider the financial assessment of climate risk. So this includes the effect of your climate risks across the three timeframes, short, medium and long term, how they affect overall financial planning, the expectation of how your financial position might change across each timeframe with a focus on investment, disposal of assets, and also sources of funding, essentially how you expect to be able to pay for that investment. Plus there's the expectation of financial performance and cash flow and the ability to change your strategy to manage your climate risks. What's the resourcing and funding available to the business to actually manage and mitigate the key impacts of the climate risks that you've identified. And then third bucket is general requirements and together with some guidance on how to disclose. So although all of S2 is a requirement, some elements basically need, it's a very general document, so some elements need some interpretation to make them as relevant as possible to the reporting organisation. One example being that when it comes to potential financial impacts of climate risk, the entity you might want to disclose a single amount or a range. Obviously, a range will often be more practical. Another practical point in the standard is that if you're not or not yet in a position to provide financial impact forecasts for specific risks, you might choose to explain why not, provide a qualitative assessment instead. And in some cases, it might make sense to provide combined quantitative assessments where separate effects aren't identifiable. These are effectively proportionality mechanisms that we'll touch on in a bit more detail shortly. And finally, this might vary by jurisdiction, but generally climate risk reporting is considered an extension of financial reporting, which means you need consistency across the financial and sustainability statements and vice versa. So in other words, what you're saying in your sustainability reporting needs to be reflected in your financial reporting. Let's say you've made a net zero commitment, which will mean you have to reduce the usable lifespan of a certain set of assets, for example. Let's say some particularly carbon intensive assets which aren't compatible with your net zero commitment. So in this case, you need to make sure that you've commensurately depreciated those assets in the financial statement to match what you're saying you're doing with your decarbonisation commitments in your climate reporting. Finally, when you revise any financial adjustments, you need to consider consistency in how you impair your assets, how you measure your assets, how you treat revenue, costs between the climate risk and the broader financial statement. So there is quite a lot to think about. Now we're going to talk about proportionality mechanisms, how not to get too lost in the detail effectively in specific conditions under which qualitative and quantitative disclosures are assessed. And I'd like to credit Jake at Edge Impact here for turning the S2 guidance into something more like a decision tree flowchart to make it all a little bit more user friendly, which is what he's done on this slide. So first off, when we assess our climate risks, first step is assessing. Either they're immaterial or they're material. Obviously, if they're immaterial, they don't need to be disclosed, although clearly they do need to be sufficiently assessed to be able to take the call that they're immaterial in the first place. This is a key line in the S2 standards. Does the reporting organisation in fact have the skills, capability and resources to prepare quantitative disclosures? Now, this isn't a get out clause. It's not enough to simply say, no, we haven't, and then just move on with your life. From what our colleagues at Edge are observing the Australian market, which is a bit further advanced in this space, there's a general expectation that large companies, especially those which are listed, and doubly especially those which are of interest to institutional investors, are expected to have the resources to prepare quantitative disclosures. Maybe not small corps or SMEs, perhaps might not be seen to need sophisticated quantification at this point, but in most cases the answer would be yes. So then you need to propose quantification methods, which is where the next proportionality mechanism kicks in. You have to pause and ask if the anticipated financial effects of the risk or opportunity are separately identifiable. What this means is, can you identify the part of the impact that is climate only? A common example would be energy pricing. Many organisations identify this as a transition risk and notice that energy costs have gone up, but arguably many recent increases might be considered due to geopolitical risk, not necessarily solely climate. So you might argue that this doesn't need to go into your climate related disclosure, although it might very well be captured and disclosed elsewhere as part of a broader corporate risk assessment, because clearly there's a strong interaction between climate risk and other strategic risks. So the question is, from the point of view of S2, can you identify those separate issues? And if not, then you probably look to a qualitative disclosure and explain why you're not providing a quantified assessment at this point, and then you'll ideally put in data collection mechanisms in place so that you will be in a position to do so in the future. If you can separately identify these risks, you look at your method and start what can be a pretty major job, I'm not going to lie, of collecting data. I'm not going to go into that in detail at this point, as Rob's going to talk us through it a bit more, but at this point note that simply some high-level assessment and estimation might be enough to show a given risk to be immaterial after all, in which case you revise your initial materiality assessment and then see whether you need to provide revisions to either the methods or the data requests. If it's material, you might find data isn't available, so either a qualitative process comes back into play in conjunction with the data improvement plan, or you try to plug the data gap via a combination of desktop research, benchmarking, use of whatever primary data you have been able to obtain, even if only partial, and in that case you can move on to quantifying those risks. Then you look at the next proportionality mechanism. Can you gather the reasonable information by the reporting date without undue cost and effort? So an example might be that, let's say you're a business with 200 or 300 sites nationally or internationally. Perhaps the initial idea might be to go to each site to carry out assessments required to quantify relevant financial impacts of flood risk, extreme heat, whatever it might be. Obviously, that's a lot of site visits, hence a lot of time and expense. And you might feel there's a disproportionate or undue cost and effort to obtain the data. So in that case, you need to scale back your methods. So in this example, you probably adopt a sampling approach or consider other mechanisms to disclose. And finally, you need to ask, is the level of measurement and certainty low enough that quantitative information would actually be useful or meaningful? The point being here that iffy quantification, so I'm paraphrasing very, very broadly here, but iffy quantification isn't necessarily any better than a qualitative approach, especially if that qualitative approach is in conjunction with a proper data improvement plan. So you might conduct an uncertainty assessment, asking effectively of the threshold to determine whether the uncertainty is low enough and aligns to existing financial reporting codes. The key point to bear in mind is that risk impacts are disclosed on the assumption that they're reasonably reliable. The overall goal is to disclose investment grade, decision useful information out to the market. So it's not enough to just hide behind spurious or potentially misleading quantification. And if the assessment can satisfy that final acid test, we've got a quantitative disclosure that can make its way into the annual reports. Otherwise, you might need to move towards qualitative disclosures. What our colleagues at Edge are observing within the Group 1 Australian companies already complying with S2 is that they're going through this process and frequently finding that due to one of these proportionality mechanisms, they're actually not in a position to disclose sufficiently robust quantification in year one. So what we think we're going to see is a lot of initially qualitative disclosures which evolve over time as models and data are refined and improving to enable a qualitative disclosure of key risks over a multi-year time frame, perhaps by years 3 or 4. So I'm now going to pass on to Rob, and he's going to provide us with a practical example of how to conduct this assessment.
Yeah, thanks, Andy. So this section is really about how you get on with doing this, walking through the method and the process you put in place. But before we kind of launch into it, I just want to say that the core of this is about trying to understand, obviously, the financial impacts, but so that you can take sensible, well-evidenced responses to the risks you're presented with. So in a sense, this is normal risk management. You need to have some level of financial exposure understanding so that you can weigh the alternative mitigation options and then build this into your investment planning. So really, if you look at the IFRS S1, S2 standards, they're really centered on the question of how does it impact the financial position and how can the business demonstrate its resilience under alternate scenarios. So if we just start with the next slide, and what I'm trying to do with this next slide is show where we're trying to get to. So at the end of this section, we'll be getting towards these kinds of numbers. And what the slide is showing is that you're trying to quantify this in the terms of financial statements, your operating expenditure, your OPEX, capital expenditure, CAPEX, and you're doing that not only for this year, which is required because you need that baseline, but you're also doing it across the short, medium, and the long term, and in this example, multiple long terms as well. And again, the reason for doing this is you need to have that clarity over the financial exposure and therefore the impacts and therefore the options you're going to invest in or the strategic decisions you're going to make to mitigate, to reduce that overall exposure. Okay, so that's the end point. How about the starting point, which is the next slide? Now, this is really where we're pitching this webinar. If you've already done your risk assessment and you're thinking about quantification or you're starting to do that quantification, this is the ideal kind of starting point. And typically that's where myself at Metis will be approached to say, we've produced a risk register, we've done the scoring for these risks as well. We now need help with financial impact assessment. So what we'll do is we'll come in, take over this risk register, and essentially we'll start by prioritizing it. Of course, a lot of this is a funnel. How do you focus on the more material issues? So for instance, the lowest scoring risks in the register are likely not going to be subject to financial impact assessment. It's not to say they're not relevant. They might become relevant with how things change each year of the assessment. But that said, we need to do the deep dive work, which is the financial impact assessment, on those that appear to be most relevant. So what we're trying to do, for example, with this client in the chemicals sector, we looked at the risk register had about 350, a bit more rows than, whereas we're just taking a snapshot of some of the highest scoring. And in total, we looked at somewhere between 35 and 40 rows as the highest scoring that required deeper attention. But what I want to say on that is that you can't effectively communicate the financial impacts across 40 rows to the board, for instance. And what we find and what the guidance says as well is you want to categorize them. So if you look at this spreadsheet on screen, it shows each row is essentially a pathway to impact, but they could have a common driver like extreme heat. And the next slide shows those common drivers on transition risk as well, because the risk descriptions on this slide show that there's some commonality for the client with transition risk. So it could be access to the EU market because of the changes in policies in the EU. Now, while there are multiple ways that could impact the client, the common driver is the EU. So in this case, we talked about the exposure to specific parts of the EU legislative scene. So in this regard, my main point is saying that while you need to do the financial impact assessment for every pathway, every row that gets the highest score in terms of your exposure, when you then come to aggregate this, you would look at salient, sensible ways to aggregate them according to the key hazard, the key variable, or the key impact. Now, if that's where we're assuming we're starting from, the question is then, what does the work actually look like? So we've got another diagram on the next page, on the next slide, just showing the logic that we work through. So typically when I'm approached with a risk register, we've almost got the business impact part of this done already. But the work that's been done before by the risk assessment team is the identification of the key risks. So in this example, the introductions of policies or regulations targeting unabated gas plants, the outcome of which is that any gas assets would need to be decommissioned ahead of the expected date. Now, I'll usually see a risk register that details the business impact, but it won't always include the financial impact. So what we'll typically do is we'll do a sense check over the business impacts and financial impacts for everything that's highest scoring. And what we want to do is thereby create our basis for quantification. And really when we're thinking about the financial impacts here, we want to put it in terms of the core accounts. So we're looking at impacts on revenues, expenditures, assets, liabilities, capital, and financing really as some of the main ways. And what you want to have at the end of this is a set of pathways that could lead to financial impact that have achieved high risk scores and are therefore relevant for financial impact assessment, the full calculation. Because otherwise, you're trying to focus your energy across 400 different pathways instead of 30 or 40. So that's why we really want to do the deep dive here. Now, once you do get to that point, on the next slide, I'm giving an example actually from a very recent project I've been working on. This is again following the same logic, and when we were at Metis were approached, we were given the client example outcomes, if you like. So we had the risk register that detailed there would be, in one example, problems and disruptions in the supply of goods or services which stemmed from physical hazards. So that was one broad category that we saw in the risk register that had multiple different pathways we could trace. So in this instance, there were three most prominent pathways. And remember, I've provided a very simple example from the exercise. The full exercise itself looked at 6 different categories of risks with 35 different input equations as well. But if you look at these pathways, we've got 3 of these: increased cost due to expedited shipping, increased inventory holding costs, and penalties due to delayed shipments. So these were all salient for the client. They were workshopped with the client and the relevant internal stakeholders to make sure that it was going to be a financial impact that's relevant. I've had other workshops where clients have come back to say that we don't actually have legal liability for these costs. So therefore, we don't think we need to conduct the assessment. Just one example there. But the input equations that you formulate are not going to be the most challenging mathematics you ever do in your life, but it is trying to find the right variables that would come up with a useful and accurate answer. So increased cost due to expedited shipping, well, you're going to want to know the number of shipments per year that need to be expedited and the expedited cost per shipment. But getting beneath that into those 2 variables often requires multiple data points to produce each of those. So what you can do here is you can look through these 3 proposed input equations just as examples, but really you're looking at a full suite being somewhere between 20 to 40, I would imagine, depending on how complicated the groupings are. And again, we're trying to look at this from across the range of financial impacts. I've seen some companies that attempt this for the first time and purely do it based on potential lost revenue, for example. And I'm not saying that's a bad approach, but it only gives a view of the revenue impact rather than the impacts across costs, asset valuations, liabilities, and so on. So in that regard, when you're trying to comply with S2 and even go towards getting your disclosures assured, you're going to want to look at the whole range of financial impacts. Now, if we stick with this example, the next slide then looks at what the data request looks like. So I've already said the mathematics itself isn't too hard, but this is where it's a little bit more complicated. So if you, on the previous slide, had 7 variables in total across the 3 different equations. They're all listed on the left. And typically what we do is we break it down between which data points can we get from the company itself and which are external. The reason being that if a company has first-hand experience or they have first-hand evidence like invoices or utility bills, or they have an experience of a relevant event or disaster in recent history, that's fantastic in terms of a primary data source on which you can base your calculations. So you get some clients that have already got that baseline impact. This year, they're already facing the impact, and that baseline is an excellent foundation that you can then extrapolate from. That said, the extrapolation often is going to be the externally sourced data. So what is the temperature increase? If I take one example from a different client in real estate, they managed certain care facilities. So they were interested in the impact of temperature rise on severe illnesses among particular age groups. So the external data we required was not only the temperature rise, but the relationship between temperature increase and serious illnesses among that particular age group. So while we can get the temperature rise from the climate models relatively easily if you've already done your risk assessment, what we had to find evidence for was the link between temperature and severe illness in that age group. This is where you go to peer-reviewed work, you go to reports from credible bodies, and at this point, I want to bring up audit because you want to make very clear where your evidence has come from. You need that paper trail of the evidence behind all of these data points. And when you bring them together, the company data and the extrapolated data with a wider range of evidence bases as well, you can start doing the calculation for each of those pathways. Okay, now if we move on, I think Andy highlighted before that ISSA 5000 is really useful for materiality. And why are we talking about materiality now? Well, we're talking about it because I'm kind of saying that you've probably now gathered your data and you've done those calculations, and for each group of risks, you've now got an aggregate figure for the financial impact. Great, it's a huge amount of the work done, but you'd need to make a materiality determination at this point too. Now, ISSA 5000, you can apply the standard in this for quantitative because it runs you through a key process. You would start by determining the appropriate benchmark. You're talking here, is it revenues, is it costs, is it asset valuations, and so on. In certain specific cases, you could use a non-financial basis benchmark like carbon dioxide equivalent, but in a financial impact assessment, it will require a financial element being brought in as well. But then once you know your benchmark, you apply the different aspects of ISSA 5000, which can include things like measurement uncertainty, what you need to put in place around the benchmark. But again, you can walk through this with great guidance from the different sections of the standard, because what you're trying to do is establish what would count as a materiality threshold. Now for clients, and the example I'll use shortly, the client already has a materiality threshold regime in place in our experience. And in a sense, what we're saying is that threshold suitable for sustainability purposes? And often it absolutely is, because it's been made in accordance with this standard as well, or similar standards. And once you have that threshold, you can then do the simple comparison to ask whether the financial impacts you have quantified meet different thresholds. Now, if you want to get into performance materiality, that's a question more about the uncertainties that are inherent in these assessments. And therefore, if you need to slightly tweak how you do the financial materiality judgment, but I'll leave that in ISSA 5000 just because of the time, but that is in there as a key step. And then you end with a view of what is financially material, which groupings are or aren't. Now, because we're looking at quantitative, I'll stop there and just say there is useful information on qualitative as well that you can dig into. Broadly follows a similar logic, just with different steps involved. But the next slide is an example of the outcome of this materiality approach. This is again going back to the chemicals client, and they were looking, they essentially required in all of the work, and it made perfect sense to do so, to apply their normal severity thresholds. So their severity thresholds were 1 through 5. And they were largely based on the USD impact of each risk. And you'll see here the physical risks are scoring a severity 2, severity 3, with severity 1 being lowest and severity 5 being highest. Now, Libby showed the slide about the CDP assessment. And so you see physical risks here. Yes, they are meeting those thresholds of severity. But if we switch over to the next slide, you'll see transition risks hitting a much higher severity level. So transition risks achieving severity 4 and 5 scoring. Now, this is just one client example, but the trend is something that we see across projects as well. It doesn't mean that transition risks are going to be harder to manage. It just means that the current exposure without additional mitigation measures being taken is higher. Now, it could be that the strategic changes can be relatively straightforward, and it could be simple decisions to be taken. So the actual mitigation measures is a different question entirely for the company to decide upon. This is simply saying the exposure at one moment in time achieves the thresholds in different ways. Now, I'll just comment on a couple of things here, linking back to Andy's point about ranges, where ranges are very practical. With transition risk, in this case, we had to use ranges because some of the assessments were, for instance, about legislation in the EU that could prevent access to a market for certain products. Now, it's very difficult to find a model that will predict a precise percentage decrease in your sales of your particular product. Instead, you need to have an evidence base for a worst case scenario and a best case scenario under each of these, or a worst case and best case. Let's ignore scenarios because we've got different scenarios in play. So that's what we try to do with the lower estimate and upper estimate here, and that's because it gives a more accurate representation of the analysis. In other cases where you can get a pretty confident readout and data point of what it's going to be, like the final point on this table, you can just use a single figure as well. But that's, to me, where the ranges become especially practical. And the final thing I need to comment on the next slide before I hand back to Nature Positive is talking about how to improve the auditability of this whole process. Now, we're seeing much more push towards limited and then reasonable assurance because this is now starting to be required. And that means that as you're developing capacity for this work, like Andy said, you might not disclose what you do in year one, but trying to quantify it is still part of the capacity building so you can identify your gaps. And as you build that capacity, start building your audit trail. So if, for example, where you've got your data, are you making sure that you can have the versioning and change logs? A lot of this information is going to be digital, okay? And the issue with that is you need to be able to show how the work has been iterated and changed over time in the process to look at key judgments that were made and how they were made. Then you're looking at plenty of models that you're using. How are you making sure you're disclosing, for example, scenario parameters? That's already required in S1 and S2 anyway, but in S2 specifically. But are you documenting the assumptions as well that have been made along the way? Data inputs, of course, link in partly with IT environment. I would say automated calculations are an especially tricky aspect, but only for those at a very mature stage. So probably not too relevant at this moment in time. Give it a few years and it could be, but essentially there, how can you make sure those automated calculations are providing the chain and they're not replacing management decisions either in the process? And finally, the few at the end, experts, making sure they're objective and competent and make sure you've got the paper trail to show it. Looking at the materiality claims that are being made, both quantitative and qualitative. So are you making major strategic claims around net zero by a certain year, and can you back that up as well? And finally, one point we do want to flag as maybe a slightly current issue is data providers. You'll often go to an external data provider in this process, and that's fine, that's normal work. However, a lot of data providers have been able to black box their methods to date because this hasn't gone through rigorous assurance processes. You don't need to see the methods. But now, as we work towards assurance, you want to make sure your data providers can confirm that what they provide can be audit ready, that they're not black boxing things where the auditors are going to flag there's a major issue because they can't look into that black box. Like I said, that's a very quick run through of what the process looks like in practice. At this point, I'll hand back over to Andy so you see what the outputs really look like from some disclosures.
Thanks, Rob. So what does this look like in practice? So just going to touch on one or two examples to how we do for time. Obviously, these are external because we don't know what's going on under the bonnet of every corporation internally. Most businesses don't disclose everything. What sits behind what's disclosed is a series of financial modelling and decision-making tools. And the aim here should be to make sure that climate is integrated within them. So obviously a good starting point is to look at what you're already doing that you can repurpose in a way for climate risk. A lot of data Rob mentioned will be based on existing business modeling and forecasts, and obviously most businesses already do some form of stress testing scenarios, have their own impairment models and so on. So look to those existing processes to align or integrate the financial impact process as well. There's no point creating a shiny new model that isn't actually going to drive any behavior change in the business. It's important that it can inform the corporate decision-making process. So Libby's going to talk us through a UK example.
First example that we'll be looking at is British Land. This is a company that owns and manages real estate in the UK. From 20 physical and transition related opportunities and risks, they modelled 2 different metrics, and that's the climate exposure and what they called the value at risk for the chosen time horizons and chosen scenarios. The value at risk metrics is a financial impact quantification of the associated asset damage and business interruption from any identified risks. The timeframes they used were short term, which is within the next 12 months, medium term is 1 to 5 years, and long term, which is 5 to 10 years. And this aligns with their corporate strategy time horizons. However, for physical climate risks, they also looked to after 2050, as this is when future scenarios meaningfully start to differ from the current climate. And that's something that organisations potentially don't look at. Outside of the climate lens, is looking at things beyond 2050, strategies beyond 2050. So that's something that's a little bit different when it comes to looking at climate related risks and opportunities. So using the combination excuse me, of likelihood and the modelled financial impact, as you can see on the right hand side here, they then determined whether any risk or opportunity presented a material impact to the company. Given that this is the UK, they identified the physical risk of flooded assets, both in present day and far into the future to a post-2050 world. With regards to the transition-related impacts, they identified the increasing price of carbon credits and the cost of complying with the minimum EPC standards, so the MEES compliance, as risks in the next 5 to 10 years. The key transition-related opportunity that they identified was increasing customer demand for green, low-carbon buildings, which resulted or may result in faster rates of letting and a rental premium. So for all of these risks and opportunities, they've quantified the potential financial impacts of these pre-insurance, so pre-mitigation, ranging from between £0.75 million to up to £12.5 million per year as well, so quite a wide range of financial impacts there. And as you can see on this heat map here, with potential financial impact on the y-axis here and likelihood on the x-axis, the likelihood of these risks occurring and opportunities occurring is relatively similar. It's the financial impact that's what really differentiates the materiality of these risks and opportunities that have been identified. So I'll just pass over to my colleague Andy, who'll go through some more examples.
Thanks, Libby. I think we're just going to look at one because we're running a bit short on time. But this is Brambles. I'm told they're the darling of the Australian sustainability reporting space. What they've done is taken on voluntary S2 aligned disclosures representing an early adoption piece, and they've been able to provide some quantitative disclosures around how climate risk will, in their view, impact their financials, so they can communicate the benefits of a low carbon advantage. They've got an opportunity leading their first disclosure showing R&D investments to improve the business model by 100 million Australian dollars, waste solutions totaling 25 million. There's a qualitative description around hurricanes in certain geographies they operate in, and it transpired that these didn't have a material financial impact. What's interesting is the line below where they talk about revenues attributed to a lower carbon economy through a circular business model, which they estimate is worth nearly 6.7 billion Australian dollars. Now, obviously, that's not a typical disclosure because it's circular economy aligned. What Brambles operate and specialise in resource efficiency and reuse in the logistics centre, so circular economy is quite central to their business model. But it does represent what good can look like in this space if you properly integrate sustainability with your business model. They also address the S2 metric about capital deployment in terms of climate-related risks and opportunities, R&D, digital projects, CapEx. Again, the idea is to disclose decision useful information for investors. So they've been able to provide the current reporting period due to the low uncertainty in the data, and then they've looked at the expected future impacts. And there might very well be some quantitative analysis beyond that, which reasonably isn't going into the public disclosure. And they've highlighted on a qualitative basis that there may be an increased cost in raw material supply or supply constraints, reducing revenue into the long term. We have got a couple more examples, but I'm just going to jump over them to allow a bit of time for Q&A. I just thought a summary key takeaway slide would be quite useful. So I think the first point is that it's really important to try to treat financial quantification of climate risk as a multi-year iterative project, ongoing improvement, not a one-off. You're not going to be able to get this perfect the first time. No one can. Identify overlaps with existing strategic risk management and quantification. What we tend to find when we work with certainly sustainability managers at client side is that they think they're starting from scratch, but it soon transpires that they're not. A lot of climate risk assessment is just a subset of corporate risk assessment, which is something any well-run organisation will probably be doing anyway, albeit not necessarily that they're aware they're doing it through a climate prism. Third one, Rob's point about combining and grouping similar risks where appropriate to ease the reporting and the managerial burden. Be prepared to start qualitative and move to quantitative disclosure over time, but obviously that's not going to take care of itself. You need to implement data improvement plans to enable this. So you want to set things going in year one that will enable you to quantify in year three. Document evidence and assumptions to get things as audit ready as possible. Rob used the term black box, which really chimed with me in the context of external data providers. That's, you know, once things come under the scope of financial audit, which they're going to, that stops being an option. So make sure you're thinking in terms of documenting. And don't be too ambitious too early. Start with a manageable number of core risks. This work really does have a way of growing arms and legs, and you want to keep it as manageable as possible for as long as possible. I think we've had some questions coming in.
Yes, thank you, Andy. I've been monitoring the questions, and as and when people think of any questions, please feel free to pop them in the question box here in the GoToWebinar. So I've got a couple come in, which I'll start off with. Let me have a look. So the first one, how can companies disclose opportunities without revealing commercially sensitive information? And how can they communicate the uncertainty transparently without alarming investors?
Yeah, I can take that. So this, I think it's right. The question pinpoints partly the opportunities, right? I think when it comes down to risk, there is an obligation to have a certain level of detail in the disclosure, but at the same time, it is a concern under the broader risk assessment as well. If we look at opportunities specifically, then what I've seen work quite well in disclosures is that the company would have a list of the generic opportunities. So for example, if they're looking in one example I saw was great. It was looking at raw materials required for electric vehicles, and they were in the business of the raw material supply chain and its refining. So they were saying electric vehicles, for instance, presents a huge opportunity. But instead of going into the precise detail and quantification of every single material and the upside, they instead were tracking the trends over time. So it could be around, for example, certain key materials. Now, they wanted to provide investors with enough information, of course, but at the same time, without giving that granularity over, say, for example, the regions, the uses that they foresee, and so on. So in this regard, what you can kind of do is give, again, this categorization around the opportunities, where you're giving the salient information, you're tracking the trends over time as well. So it could be stagnant in 1 year, say, because of political situations changing, whereas it could ramp up afterwards. So I think the key point is you're trying to give a very clear indication of direction of change, and you're trying to disclose material information with enough information so they can see the scale of the opportunity without necessarily having to be as granular as putting your entire strategy down on paper.
Brilliant, thanks, Rob.
Libby, they had a second part of the question as well about transparency around uncertainty, right?
Yeah, how do you communicate the uncertainty transparently without alarming investors?
Yeah, okay, I think Andy's touched on this a few times about the iterative process. The uncertainty is inherent because we're talking about the future. So it's always going to be there as part of this type of scenario analysis and quantification. So in a sense, don't try and hide it. One of my favorite quotes around scenario analysis is that it's very easy to go from being roughly right to precisely wrong. So in a sense, the uncertainty is part of it, and you want to be roughly in the right place to get the insights you need. If you feel you've got a very high degree of precision, you could be way off. So in that sense, the point around this is uncertainty is inherent. Don't try and hide it. When the uncertainty comes down to essentially you not quite having the information at hand, though, disclose the capacity building. Be transparent that this is a work in progress. What are your plans for next year? What are you going to try and achieve? You disclose that one year, you'll be held accountable for it the next year. But it's just transparent and open and accurate representation of where the company is.
Excellent, thanks, Rob. We've had another one come in on a similar vein, but what constitutes a material risk or opportunity? I guess how do we define that materiality to a company? Have we got any thoughts on that?
Andy, do you want to start, or do you want me to?
I just start by saying it depends. I'll leave you to expand on that, Rob.
I think, a lot of this is with S2 and S1, these standards are not trying to completely reinvent professions like risk management. They're definitely not trying to reinvent the core financial accounting standards either. So when we think about materiality, if you have an approach to materiality in your company's risk management process, so for instance, you have those thresholds in place established for what constitutes material risk to the company, that is your starting point for looking at sustainability. The fact that it's sustainability doesn't mean that the risk management approach needs to change. The purpose of S2 is to convert, for example, climate change and the science of climate change into something that the risk management profession can handle. So we're not trying to reinvent the entire process. We're trying to convert climate change into something that these day-to-day systems can handle and work with and can effectively manage. So in that sense, I'd say that materiality is well established elsewhere in the organization. The same approach needs to be taken. But if you're talking about numbers, then typically you're talking about what percentage of revenue loss counts for different levels of severity. So are you talking about not even revenue loss, but what USD equivalent of exposure would it look like? And typically that's calculated as a percentage of annual turnover, even if the exposure is to costs or asset valuations instead of turnover. I'll stop there, otherwise I'll talk for hours if you don't stop me.
Well, we do have 6 minutes left, so I'll stop there and move on to the last question I've got in the chat at the moment. What if I think this kind of alludes to the summary point where Andy was talking about it being an iterative process. But what if we don't have all the data yet? I guess kind of what are the first steps to getting the data available so you can do this iterative improving cycle of financial quantification?
I mean, Andy, I know you cover this probably a huge amount in carbon accounting as well, don't you? I mean, do you see parallels between the two here because the data sets are connected somewhat?
It's funny. I was putting together I work a lot in Scope 3 GHG accounting, and was putting together the summary and take-home message slide. There's quite a lot of overlap between approaching a Scope 3 GHG assessment and approaching climate risk. I suppose the first step is to find out what you don't know. And then think in terms of plan forecasting and milestones to get to where you need to be, but over time and realistically and clearly. This is where the point you made about not trying to move forward with 350 different risks, Rob, is so important. If you can move forward with a dozen or a couple of dozen risks, then you might be looking at something manageable in data terms. But it's so easy for these projects to grow arms and legs and turn into an absolute morass of data, which may or may not be accurate and particularly useful. So I think it's about clear thinking, cutting the suit to the cloth to an extent, being prepared to work with what you've already got or what you can realistically get, not being too idealistic, but equally not necessarily just taking no for an answer either. I don't know if you'd have anything to add to that.
I think it's a really nice summary, to be honest. I think I would probably, one thing I've seen that I find really dangerous that companies might do is use the lack of data as an excuse for stopping halfway and kind of saying, well, next year we'll have better data. But the thing is, I think there's a couple of things. Even if we ignore the S2 requirements, right? We just say, if we just look at this from a data problem, if you say we don't have the data available, hopefully next year it will be better. Well, even if there are other initiatives in the organization to create that data, you don't know if the data is what you need for this work. So I would say still push through and see how far you can get, because you are going to learn the data requirements you have that you can then inject into those other initiatives. I would also say, if you go through the entire process and you don't have good quality data, maybe that's partly down to resourcing issues. Therefore, one of the cleverest things I've seen one team do in the UK was they didn't quite have the resources they needed. So they did quantify the financial exposure. They shared that with the CFO, and it was something like £300 million, and said to the CFO, in 3 years' time, we're going to have to disclose this to investors. And at that point, the CFO is quite eager to understand the calculations behind that sum and to make sure the data is accurate and has good quality. So in a sense, you enroll the CFO in your project. And this brings me to the point about the disclosures of your friend. Under the IFRS standards, the S1 and S2 standards, you need to be clear about where you are in capacity building. So if you don't have the data, do you really want your disclosure to read, well, we don't have a compliant disclosure because we don't have the data, but we have no plan for getting the data either? You have to be transparent about your position in terms of capacity building, and you probably want that to be a positive story. So again, I would say push through that and say, if you don't have the data, how close to compliance can you still get, including a plan that sounds like you will be compliant within a couple of years, because you want to be credible on this to the market. Otherwise, it's a very negative story to be telling, just saying we don't have the data and we don't think it's that important to invest in getting the data either.
Great, thanks, Rob. I think that's a really, really interesting and good point to close off on there. So I don't know if Andy or Rob, you have any closing remarks, but at that point, I think we're at time.
I would come back to what Andy said about this being an iterative process, because I think for a lot of people, they will look at either this entire process or certain parts of it and be terrified. I ran a project in 2021 for the UK's Financial Reporting Council, and part of the brief, although it wasn't publicly informed on the RFP itself, but it was the FTSE 100 are scared of climate scenario analysis. Can you do some work to try to demystify climate scenario analysis? And that's the FTSE 100. So everybody that sees this is going to be anxious about how to do it. And I find this year people are anxious about financial impact assessments too. So to Bandy's point that it's iterative, I think get started, give it a go. You won't probably need to disclose it the first time round from a proportionality point of view, but you will want to give it a go internally because it's being done, people get through it. You figure out how to do it in the first year, and in year 2 or year 3, you can get compliant disclosures. But the anxiety is normal. That doesn't mean it's necessary, though.
Yeah, I just add, yes, start early, and don't fall into the trap of focusing on the disclosure itself and the reporting to the exclusion of everything else. The disclosure should flow from the process, not just be treated as the end in itself. That's as with TCFD, as with a lot of GHG reporting, it's all part of a process, and the disclosure is, in one sense, almost a little bit of a red herring. It should just summarize summarize and disclose what you already know internally. Okay, I think we wrap it up there. Okay, thanks everyone for joining us.
Yes, thank you very much and have a great day.
Yeah, thanks everyone. Goodbye.